Are management accounting techniques vital for decision-making? This video explores their role in strategic planning and financial control. Discover how these methods can enhance organizational performance. Budgeting involves creating detailed financial plans for future periods. Forecasting predicts future financial outcomes based on historical data and market analysis. These techniques help set financial goals and allocate resources efficiently. They also identify potential financial issues before they arise. Together, they form the backbone of financial planning. Activity-based costing allocates overhead costs to specific activities. It provides a more accurate method of costing products and services. Managers can make better pricing and product mix decisions using this technique. It focuses on resource use, improving cost accuracy. This method is crucial for competitive pricing strategies. Marginal costing focuses on the cost of producing one more unit. It's essential for pricing decisions in competitive markets. This technique evaluates production changes' impact on profitability. It helps managers assess the financial implications of production adjustments. Marginal costing is a key tool for short-term decision-making. The balanced scorecard integrates financial and non-financial measures. It provides a comprehensive view of organizational performance. This tool supports strategic planning by linking metrics to strategic goals. It ensures alignment between performance and organizational objectives. The balanced scorecard is vital for long-term success. Variance analysis compares actual performance against budgeted figures. It helps understand reasons for variances and take corrective actions. This technique identifies performance gaps and supports control. It is resource-intensive but crucial for cost management. Variance analysis focuses on short-term financial control. Cost-volume profit analysis examines relationships between costs, sales volume, and profits. It determines the break-even point and aids in pricing strategies. This technique evaluates the impact of cost or sales changes. It is essential for understanding profit dynamics. CVP analysis supports strategic financial planning. Budgets serve as financial plans outlining expected revenues and expenditures. They typically include sales forecasts, production costs, and capital expenditure plans. Budgets help in planning and coordinating activities. They also control resources and motivate employees by setting performance targets. Budgets are essential for financial stability. Cash flow forecasts predict the inflows and outflows of cash. They ensure the organization can meet its financial obligations. Detailed estimates of cash, receipts, and payments are included. This technique is crucial for liquidity management. Cash flow forecasts support financial planning and decision-making. The budgetary control process involves setting budget targets. Monitoring actual performance is crucial. Comparing actuals with budgeted figures helps identify variances. Corrective actions are taken based on these comparisons. This process ensures financial discipline and control. Zero-based budgeting starts from zero, justifying every expense. Incremental budgeting adjusts the previous period's budget for changes. Both methods have advantages and disadvantages. Zero-based encourages thorough evaluation, while incremental is simpler. Choosing the right method depends on organizational needs. Budgets provide direction and improve coordination. They facilitate performance evaluation but can be time-consuming. Budgets may lead to inflexibility and short-termism. Despite these challenges, they are crucial for strategic planning. Understanding both sides helps in effective budget implementation. Costs are classified as direct, indirect, fixed, and variable. Direct costs are attributed to specific products, while indirect costs are not. Fixed costs remain constant, while variable costs change with production. Understanding these classifications aids in accurate pricing. Cost classification supports strategic pricing decisions. Unit cost is calculated by dividing total costs by total units produced. This metric is crucial for pricing and profitability analysis. Accurate unit cost calculation ensures competitive pricing. It also aids in understanding cost structures. Unit cost is a foundation for financial decision-making. Full absorption costing allocates all manufacturing costs to units produced. Activity-based costing assigns overheads based on cost-driving activities. Both methods offer insights into cost structures. They support pricing and product mix decisions. Choosing the right method depends on organizational needs. Break-even analysis determines the sales volume where total revenue equals costs. Marginal costing focuses on the additional cost of producing one more unit. Both techniques aid in pricing and profitability analysis. They support short-term decision-making. Understanding these concepts is crucial for financial planning. Capital investment appraisal evaluates the viability of significant investments. Techniques include accounting rate of return and payback period. Net present value and internal rate of return are also used. These methods compare projects and guide investment decisions. They ensure informed financial planning. The accounting rate of return measures annual profit as a percentage of investment. Payback period calculates the time to recover the initial investment. Both techniques provide insights into investment viability. They support strategic financial decisions. Understanding these metrics is crucial for investment planning. Net present value calculates the difference between present value of inflows and outflows. Internal rate of return is the discount rate making NPV 0. Both methods assess investment profitability. They guide long-term financial planning. Understanding these concepts ensures informed investment decisions. Management accounting techniques enhance decision-making. They improve financial control and align with strategic goals. Techniques like budgeting and ABC provide detailed insights. They support resource allocation and strategic planning. Understanding their strengths and weaknesses is crucial for effective implementation. Organizations leverage management accounting techniques for strategic decisions. Techniques like the balanced scorecard and budgeting enhance performance. They align financial planning with strategic objectives. This ensures long-term financial stability. Understanding these applications supports organizational success. In conclusion, being able to apply management accounting techniques for decision-making is vital for guiding organizations toward improved efficiency, profitability, and strategic success. Techniques such as cost-volume profit analysis, budgeting, variance analysis, and marginal costing provide managers with valuable insights that support informed choices. By using these tools effectively, managers can evaluate alternatives, assess risks, optimize resource allocation, and respond proactively to changing business conditions. Mastery of management accounting techniques enhances decision-making quality and contributes significantly to overall organizational performance. Thank you for watching this video. If you have any questions, please feel free to contact us via email or WhatsApp at 07484361688.